Good evening, everyone. I hope you all are well and doing, and thank you so much for joining us today. On behalf of Impact Investors Council, it's a real pleasure to welcome you to this special conversation, which is about the insights from UN's Financing for Development conference that happened in Seville, Spain, and what it could mean for India's impact finance roadmap. We understand that global conferences can sometimes feel far away from the work we do on ground, but this one is different. The financing for development process is where major decisions and directions around how we fund development get shaped. It's where governments, multilateral agencies, philanthropies, investors come together and talk about financing the SDGs, tackling debt, reforming the international systems, and unlocking climate finance. This year's conference in Seville, Spain, the fourth in the series, marked a critical milestone. It concluded with the adoption of Civil Commitment, a collective agreement by UN member states to mobilize capital and reform global systems across seven big themes, from domestic resource mobilization to domestic private sector engagement. During this conference, over 130 initiatives were launched, and the energy was both urgent and hopeful. So today's session is about understanding these shifts and grounding them in our Indian context. What can our ecosystem of funders, investors, CSR leaders, and policymakers take away from this conference? How, how do we show up at the global table? And what might India's roadmap look like? We are grateful to be hosting this conversation with our wonderful partners for today, Desai and Associates and Aspire Circle. Introducing our first speaker for today, Mr. Karthik Desai, founder and CEO of Desai and Associates. Karthik brings experience across philanthropy, private capital, and public policy. He recently participated in the fourth International Conference on Financing for Development in Seville, Spain, and will be sharing his reflections on key global shifts, blended finance, and what India's response to leadership could look like in this evolving landscape. So over to you, Karthik.
Thank you so much, Mala. And I also want to acknowledge, Girish, as well as Suresh, uh, uh, and IIC for hosting this webinar on this important topic, and to Aspire Circle as well for participating in this program. Uh, so as Mala said, the objective here is to debrief on what happened at FFD. So I'll take you through a presentation which I've prepared based on the reflections from the conference, both covering the global trends, what exactly is happening at a global level, and focusing on what was discussed specifically with respect to blended finance and outcomes finance, which had a major role to play over there. And then we're really going to then try and apply that to India. What does this mean for India? Our honorable finance minister was there. She spoke. It's actually a head of state summit level conference. So a lot of world leaders were there. And how does one then take all of those global discussions and apply that in the Indian context? And of course, IIC represents the leading impact funders who are active in India. So then Girish will share perspectives on the impact investment industry. And Aspire Circle obviously has a lot of leaders from the philanthropic and from the NGO and the social sector. So what are the implications for them? And then we'll have an open discussion. So let me start with the presentation right away. So we'll take about 20 to 25 minutes and go through this. As Varun mentioned in the chat, I know you will have a lot of questions, so please feel free to put those in the chat box, and at the end of it, we'll select some of the most pertinent questions and do a Q&A. So let's get started. Before we start with the actual presentation, I was encouraged by Suresh to briefly touch upon the key terms that are being covered. Obviously, the assumption here is that most people here are practitioners, so they've heard these concepts before. But we all know about the spectrum of capital, where on the left you have higher impact and on the right you have higher commercial returns. So you can see here that many of the segments that we speak about, how they are reflected here, right? ESG and SRI are very much at the commercial end, and public finance and philanthropy at the philanthropic end. Impact investing is somewhere in the middle because, of course, there's finance first investing and impact first. But what we're really focusing on today is blended finance and outcomes finance. And if you look at the bit on the bottom, right, this is another way of thinking about this, that we're quite familiar with what grant capital does and what commercial capital does. But there's this other concept of catalytic capital, which is somewhere in between, which is how do you use philanthropic capital to crowd in commercial capital? There's not as much of this as we would like. So a lot of this conversation is around catalytic capital, which sits somewhere between commercial capital and grant capital. So just wanted to make sure that everyone is, familiar with these basic terms. And we'll start now with first just talking about the very basics, right? What is FFD? Many people in India have asked me, that what is even the context of this? There's so many conferences, but this is not an ordinary one, right? This is something which happens once every decade. The previous one was in 2015 in Addis Ababa in Ethiopia. And the very first FFD conference actually happened, I think it was in 2002 in Monterrey, Mexico, in early 2002, shortly after 9/11 had happened. And this is where the so-called Monterrey Consensus and the very idea of financing for development was mooted. It was essentially about north-south, dialogue and collaboration. A lot of the wealth is sitting in the global north, and a lot of the developmental needs are in what's alternatively called emerging markets and developing economies, EMDE, or the so-called global south. But there needs to be an understanding, right, amongst the rich and the people who are aspiring to get rich. That's what a lot of the work of sustainable development is about. So there was a whole initiative around sustainable development, that started in Rio with the Earth Summit. And of course, you have now the Sustainable Development Goals. So I'm sure everyone is familiar with sustainable development, but how do you finance that? So FFD is basically about that. In a nutshell, the conversation at that time, at the beginning, was about something known as ODA, or Official Developmental Assistance, which is literally just money coming from wealthy countries, primarily the OECD countries, to developing nations. And developing nations can also be categorized, right, as medium income or low income, as large, like our country is, or very small. So the key stat here is this number. What they agreed was, this is a big commitment, that 0.7% of their gross national income, or their GDP basically, would be given every year to developing countries. There was also talk of debt relief and fair trade. So it was essentially a way of creating a partnership between the North and the South. And this is the original legacy. So this is just a brief about what FFD, is conceptually. Now, just jumping ahead to, where we are today and the role of private capital. As I mentioned, the previous FFD was 10 years ago in Addis Ababa, and there they launched something called the Addis Ababa Action Agenda, a lot of acronyms, AAAA. And in Seville, there's something called the Seville Commitment, or the Compromiso de Sevilla in Spanish. So this chart, and we'll share this presentation with you afterwards, essentially tries to show how blended finance was mentioned back in Addis Ababa. But in the last 10 years, it hasn't actually done as much as it has promised. There's an organization called Convergence, which tracks the data. And they've shown us, that, for example, just last year, there was a total of $18 billion of blended finance mobilized only for developing countries, right? This is only for emerging markets. And roughly half of that, or 7 billion, was from private investors. So Mr. Marcos Paya, who's a partner of Dalberg, has done this very interesting analysis, which basically shows how we are now shifted from broadly talking about blended finance at Addis Ababa to now the world is actually trying to figure out, like, how do we really make it work? Like, why has it not scaled up? How do we, make it more effective? And how do we make it more scalable? And that's what we're going to basically talk about in this presentation. before we get to that, just one more context setting thing, which are, what are the key global trends shaping developmental finance? And all of these were discussed in Seville. And again, just to give you context, there were 20,000 participants at that conference. About a portion of them, maybe 4 or 5,000, were in the official, the political delegations from the various countries of the world. And the balance, I would say at least 10,000 or 15,000, including civil society, was the private sector. So representatives of all the major global funds, foundations, so there were over 400 side events. And I've tried to basically summarize that into 6 bullets, right? As to what are the key global trends which were being discussed there and which would be evident to many of you who are working in developmental finance. The first one, of course, which everyone talks about, is the shrinking ODA budgets. The time of ODA is reducing, right? So we cannot be dependent on that. Of course, we all talk about USAID uh, and how that money is pretty much gone. But let's not forget other large OECD countries, including the 2 largest European budgets, which is France and Germany, are also reducing their budgets. And there's a number there, right? That there's literally a 9 to 17% drop in ODA. So that's trend number one. Overall, at a global level, there's a severe underinvestment of private capital. There's almost 500 trillion of financial assets, but that's less than 20% of those are held collectively in the global south. Similarly, with climate finance, almost 80% of all climate finance happens in either East Asia or Western Europe or North America. So that's a serious challenge. So these are the sort of macro trends. Many developing countries, 54 in particular, are now spending 10% or more of their tax revenue on interest payments. So there's a severe debt crisis that many countries face. Not India specifically, but other countries are facing that. So there's a lot of talk of debt relief or this concept of debt for nature swaps. And then the fifth point is an interesting one, right? We're familiar with the geopolitics of China and the rise of China overall, and the BRICS and the attempt of the global South, India, China, and other countries, creating alternative mechanisms. And that's an interesting dynamic that was also evident there. But what's happening is that, there isn't still that much collaboration going on at the South-South level. There are efforts to do so, but it's not as open, it's not as transparent. So that has also been sort of a constraint, which we're looking at. And of course, the last point, I mean, I think all of you would have seen the news yesterday about, the trade tensions that are happening. And that's a global phenomenon, again, not just with the US, but globally. And there's literally a small decline in global merchandising trade that the WTO has forecasted. I think that itself, shares a lot. So these are the major global trends and challenges that we're facing. Now, based on this, just covering the key blended finance outcomes, right? Now, the first point is that the document that the UN officially released at FfD mentions blended finance like dozens and dozens of times, and I've highlighted here the specific clauses that do that, right? So if those of you who are reviewing the document later can see that, and there's some key issues here that it talks about, right? Most importantly is to fairly balance the risks and the reward. Secondly, to create some predictability and standardization, right? It can't be bespoke and unique each time. And critically, how do we actually mobilize more private finance? This is a key theme. So all of this is credit to Convergence, Blended Finance, the Global Industry Association. And I'm going to walk you through 3 sets of data points that they shared, which really will bring this point home at a global level, right? So the first one is just look at how small these numbers are. They did an estimate that each year, approximately 60 billion of private capital is mobilized. And they've even given you the exact breakup of how much comes from whom, right? On average. So IFC gives, let's say, 15 billion. MIGA, which is the Multilateral Investment Guarantee Association Authority of the World Bank, gives, the numbers are in front of you, right? USAID was the biggest at 6 billion, and so forth. Proparco of France, BII of the UK. So you can literally see that the number is negligible at a global level. They estimated that this the yeah. So the point here was that only 10% or 11%, to be precise, of 142 developing countries are investment grade. And the average rating is, you can see there, a triple B minus, and a fully 75% of them are rated B or lower. So this is essentially a key issue, that how do you reduce the cost of credit and get more capital flowing, and why there's a need for blended finance, because that's precisely what blended finance does at a global level. It makes lending to riskier propositions more attractive. So this is a scenario on lending at a global level. And the next slide will talk about something which we won't get into the details of, but this report is available in the public domain, which are how do you standardize different blended finance models for mobilizing private capital. So Convergence has put out a very detailed report on this, and there are 12 different models that they have created, which are called, private investment mobilization models. So I would direct you to the axis on top, which talks about what are they trying to do. What is blended finance trying to do? So either you have to increase the number of viable projects, because one of the complaints is that there aren't enough good projects, or you have to increase the investability of those projects. So a full, 6 of those models relate to making the projects more investable through different mechanisms like value chain financing, political risk insurance, guarantees, and so forth. The third approach is how do you increase the investability at a portfolio level? So where you have multiple projects, there's a need for aggregation vehicles. Uh, so there's an idea of a public sector blended finance debt fund or a private sector based blended finance debt fund. And finally, how do you develop your domestic financial sector? That's also one of the big themes, right? That every country, including ours, has to mobilize domestic resources as well. And a critical one for the international capital that's coming in is always going to be foreign exchange risk or FX risk. Currency hedging costs often make investments prohibitive. So there are different models which have been created, and different DFIs and large institutions are now evaluating how do we, standardize, because one of the big challenges of blended finance is its bespokeness. So this is on blended finance. And moving ahead to the key sort of takeaways, uh, I'll skip over this slide, but this is essentially stats around blended finance in India. And the next slide as well will cover that. But let's skip through that just in the interest of time, because I also want to touch upon outcome-based finance. And outcome-based finance was equally, a highlight. And these are overlapping concepts. Think of it as a Venn diagram. This outcome financing essentially means how do you deploy developmental capital better? And blended finance is about how do you unlock more capital. So more capital, better use of capital. And of course, the two can overlap. Ideally, you need both, right? So what about outcomes finance? Just go ahead. There's a sort of a major initiative called the Outcomes Financing Alliance, OFA. And OFA actually has brought together all of the various actors who have been working on outcomes financing. And at the conference, they announced some 3 or 4 major announcements. One was there's something called the Outcomes Accelerator. This is essentially giving design grants to people who are developing outcome financing initiatives, and it's managed by a consulting firm called Levoca. They're the secretariat. The OECD also gave its guidance on OBF, on outcome-based finance, and how do you align around this. And most importantly, there's a fund. There's actually a $100 million fund headquartered in the UK called the SDG Outcome Fund. This fund announced its close. It's currently evaluating projects across the world, including several in India. And if anyone is working on large outcome-based funding projects and would like to be connected with them, that can be, that can be done. And just moving ahead, the example of OBF, just go ahead to the next slide, which I wanted to share, which is one of the most prevalent examples from India, is just go to the next slide, Baran, is the Skills Impact Bond. So Shri Jayant Chaudhary, who's the Minister of State for MSDE, the Ministry of Skill Development and Entrepreneurship, was actually present in Sevilla. He was brought there by the British Asia Trust, which has been a pioneer in developing outcome-based, funding programs through social impact bonds. And India, as you know, has had 2 large provider SIBs. One is in education. It's known as Quality Education India, QEI, and the other is in skills. It's known as the Skills Impact Bond. So Skills Impact Bond has now run its course, and it's looking at the next phase of Skills Impact Bond 2.0. And the crux of this is essentially making the outcome payment or paying the training provider who does skilling based more on placement and retention. Right now, what happens is many of the training providers are provided input-based budgeting just for conducting training or maybe for conducting certifications, right? But less people are placed, and of those placed in jobs meaningfully, very few are retained. So you can't just suddenly switch the goalpost, right? Because the training providers will then struggle. So how do you do it in a measurable way? And how do you actually measure the effectiveness of getting people into jobs? And who is people, right? The different kinds of people. So it can be applied to multiple segments. And one of the most important segments, which this focuses on, is women, right? So I don't know the exact target, but there's a specific. Sorry, it's written right there. At least 60% of the candidates must be women. So 50,000 people are being trained through this program, of which 60% are women. And this was amazing to see this, that Mr. Jayant Chaudhary himself was sitting there on the stage talking about the Skills Impact Bond, which is definitely a signal of the government's intent and commitment to scale up outcome-based finance. Just go ahead, please, because I'll quickly wrap up. Go to the next section, last section, which is now, what does this mean for India? Okay, what does this mean for India? So firstly, next slide. I just wanted to give brief context. We'll skip over these numbers and go to the qualitative content. But we know that yeah, just stop on this slide for a second. The needs are enormous, right? And there's three basic sets of stakeholders who need to work together: capital providers, right? Which is public, private, and philanthropy. And you can see the numbers there. Today we're going to focus much more on private capital, which Girish is going to speak about, and philanthropy, which Suresh is going to speak about, and then the regulatory issues, right? That come with this. So just go to the next slide. Now, this is what our honorable finance minister basically said, and it was amazing to hear it directly from her. It's beyond blended finance, but you can see the fourth bullet is on that. This is kind of a nice way of thinking about what does India need to do. And blended finance is a global topic. Let's go back to the north-south stuff, right? The West is telling us what to do, and that doesn't inherently mean that it's wrong. But what is our perspective? Like, what is the Indian perspective on all of this as a large country, right? Developing country, but also on the path towards being developed, right? So number one, and this is very, very much in that order, is to have a very strong domestic financial sector. That's the most important priority, our banking sector, capital markets. Second is, and this is what is something which is being worked on, is strong regulation, right? SEBI is a good regulator. The better the and more transparent the rules and enforceable contracts, that boosts investor confidence. So it's wonderful to hear them speaking about these foundational aspects. Third one is very much related to all of our work, which is how do you create investment-ready pipelines? The government will often say, look, don't keep telling us it's a question of regulation. Where are the good projects? And they always give the example of renewable energy. Renewable energy saw a 50x growth in the last decade because of structural, reforms and target-driven, pipeline development, and then large amounts of institutional capital coming in. So that's how investors are thinking. They're saying, where is the next sector where we can achieve this type of scale? Of course, they're aware that blended finance can be a major catalyst. How do we get that capital in? But it has to be done transparently, measurably, and locally anchored. And I'll come to that. That this is the Indian perspective on blended finance. Of course, we have our own view on reform of the multilateral system, right? From the UN Security Council to the governance of the World Bank and other institutions, right? But beyond that, we want them to actually expand their concessional arrangements and do more, than they're already doing. So that's welcome, but more of that. We have a very strong view on wanting to create better credit ratings, and this question of potential bias in that. I mean, one example I'll give is someone said that the credit rating of a country like Italy, and I'm forgetting which was a large African country, have a similar credit rating, but Italy will get investment and that African country won't. Of course, there's a reason for that because the Italian currency is backed by the European Central Bank. But in the Indian context, we feel that our credit rating could be better based on our GDP growth and the fiscal fundamentals of our country. And there is this issue of potential bias in credit ratings because whatever the credit rating is, that's how much capital you'll eventually get. And then, of course, the last point is capital has to also flow to SMEs, which is very, very important. And it's not just capital. There needs to be capacity. There needs to be market linkages. So that's the work I think that will resonate a lot with the folks from Aspire. And just moving ahead and coming to the close here. So these are the three key takeaways for me, of how do you make blended finance relevant for India? And this is something that our regulators, the vice chairman of the Niti Aayog, and other people are currently thinking about, right? And people like us are, helping them think about it, which is how do you localize it? The government says we don't want all our funding coming in from the outside, from offshores, right? It should come through AIFs, through NBFCs, through domestic institutions. But of course, there's regulatory tweaks that may be needed to enable that. So localization, and they want it in the priorities areas that they're talking about. Secondly, and this is a sensitive point, that they say that blended finance needs a lot more transparency. Okay, not just the transactions are bespoke, but you don't know what the pricing is, right? It's not revealed. There's no industry database of the detailed deal information on specific transactions. Yes, Convergence manages that, but Niti Aayog should also be managing it, or DEA should also have that database. It doesn't exist. And equitable risk sharing, that concessional capital or public capital should not be seen as just providing a benefit to private capital. So how do you create more appropriate risk sharing? It can't be that the private capital gets all the upside and all the risk is borne by the public. So these are challenging issues, right? But the good thing is, for me, it was eye-opening to hear the government talking about this. It means that they're thinking seriously about these issues, and these are valid perspectives which we cannot ignore. And the last one is on developmental additionality. That blended finance is supposed to create development. So can you please clearly demonstrate that, right? It's not just about bringing in more capital, and make sure that it is aligned with government programs, government flagship schemes, even government metrics and KPIs. Why do we always need to have an external, consultant to measure all the outcomes when it can be done through existing metrics that exist? So this is what was being discussed over there, and I think it's quite interesting. And with that, I think just a couple more points, and this is more, I think, for Suresh to talk about, which is, we have a serious gap in our social sector funding in India. There's some numbers there, right? 25 lakh crore, 8.3% of GDP, right? As a proportion of total expenditure, it's actually going down, right? And one could slice and dice these numbers with respect to the different types of private capital that are there. CSR is one big bucket, but then H&I philanthropy is another one. My firm right now is doing some work on that, with folks in Accelerate India Philanthropy, and we'll be putting out a report on how outcome financing can, some models can be used over there by H&Is. But there's a big gap, which is there in social sector funding. And I think this is the next one is the last slide. Yeah. So basically, this is why innovative finance has a role to play, right? And to completely remove the jargon, it's about more capital, cheaper capital, which is lower cost of capital, and better capital. So outcome financing is for the better capital, blended finance is for more capital. So how do we actually go and do it? Key takeaway, a lot of discussion of this at the global level at the UN, which is wonderful to see. But now it's time to create an India-specific action plan and roadmap of how do we actually apply this in India. So with that, I'll stop. And again, my sincere apologies for the technical interruptions. Really sorry about that. And turn it over to first Dr. Suresh Reddy, to share his perspectives on all of this.
Yeah.
And what's happening in philanthropy. And, you were mentioning that recently you heard Mr. Kant also speaking about this somewhere.
Yes. Thank you. Thank you, Karthik. It is a new perspective altogether, and also global perspective. So one has to be up to date what is happening around the world and where we are and how well prepared ourselves to tap this blended finance or outcome-based finance. Just recently, just a week ago, had a similar kind of conversation with Sumit Tayal, the CEO of the Give. As it brought out the some report on the Indian contributions through the philanthropic CSR and retail. How much money is coming to the social sector apart from the what government has been doing it, though it is a compared to the government spending, the capital coming from the private sector, it is a minuscule irrespective of that. But how much is the money coming to the Indian society is almost all 1.2 lakh crores, and out of this equally distributed among the CSR and philanthropic as well as the retail. So among these three, most of the social sector organizations, NGOs, are they know how to at least to able to reach and build the collaborations with the corporate sector and avail that kind of capital is available. How much successful is different story, but they know the how to reach and kind of thing. Whereas philanthropic funding and retail funding, that is something they are lacking the strategy or maybe the know-how how to approach and tap that resources. Here in this case, we are talking about the blended finance and outcome-based finance. These are all new segments, and the social sector in the country, are they are equipped, are capable of, are aware of. So how to tap this kind of resources available in context of the bilateral, multilateral contributions is coming down, and government contributions to the NGOs are coming down, and also the FCRA contributions from the foreign countries, this is also coming down. So from that perspective, so the traditional method, traditional approach, what we have been following for the funding or financing, which is changing. And so as per the changing times, the social sector institutions in the country, they also have to the change to tap the new instruments. Apart from this, like a social stock exchange in India, that is what I'm talking about. The social startup or social businesses, that is something is coming up. The new billionaires, so they're also making the contributions, but their own way of making the contributions. So from keeping this perspective, all these things, how the Indian NGOs or social sector organizations, they are have the robust systems and process, the governance system, and the capabilities of tapping the different kinds of the resources kind of thing, and able to meet the due diligence process. So if they can prepare themselves and diversify their funding portfolio from different sources. And again, I'm talking about the Indian NGOs also, maybe various like companies like MNCs or the Indian companies, SMEs and PSUs, different kind. Each one of these companies do the CSR differently. Like the NGOs also, we have larger NGOs established kind of thing, the Indian the foundations which are there, and small NGOs. So each one of them, they have their own strength and their own and limitations, difficulties. So keeping this in mind, one side is the opportunities, the other side is the their own current status. So how to match between these two and leverage the new instruments of the finances are available, and make the sustainable financing for the social development. So this is something I thought of. One has to reflect and prepare themselves for the future. So I stop it here and I request I
Girish.
Girish to share his thoughts.
Girish, it'll be wonderful if you can talk from the, what you're seeing, because you're representing all of the leading impact investors.
Yeah, sure. Thank you so much, Karthik, and thank you, Suresh. Good to hear your presentation, Karthik, and thank you for sharing those wonderful insights and details. So what I will do is I'll speak on two things. One is the trends that we see in impact investing in India, basis what we have, addressed and written about in our Market Pulse, which is our monthly newsletter. as well as I'll speak a little bit about the implications for impact investing in for Global South and also for India, basis what one could surmise from Karthik's presentation. So overall, if we look at the deal flow into India, 2024, calendar 2024 versus calendar 2023, we have seen that there is an overall increase of about close to 50%. So 2023 calendar year saw an inflow of about $3.5 billion, while as 2024 saw an inflow of about $5 billion. Financial inclusion and climate continued to lead with about close to $1 billion each in each of the top 6 sectors which IIC tracks. Having said that, climate tech, the moment in climate tech investing has increased substantially with a quarter-on-quarter growth and a year-on-year growth of close to 30%. We have also seen within India that institutional climate integration has been ramping up. Institutional investors now acknowledge financial materiality of climate, and close to 50% of these institutional investors have started incorporating climate in investment policies. Now, there is also decent demand for standardized impact structures. And therefore, we have also seen that Indian capital ecosystem is shifting towards replicable vehicles like outcome bonds and guarantee-based credit overlays and scalable thematic instruments. The 3 things that Karthik spoke about, which was on localization, in the Indian government wanting funds to flow through AIFs, risk sharing, I particularly like that line, which is not subsidizing private returns at public cost. And the third one is on additionality. I think these 3 will continue remaining key regulatory demands and asks from institutional investors in India. And that is what investment managers must address in their structuring. Key implications for impact investors, the way we look at it at IIC, is we have seen that blended finance has emerged as a core instrument. And we have seen multiplicity of deals. And therefore, impact investors must partner with DFIs to access tools like credit enhancements, first loss facilities, and outcome-linked funds. We have also seen that outcome-based finance has been gaining ground. New vehicles like STG Outcomes Fund and the Outcomes Accelerator will, in the years to come, scale in sectors like health, education, and climate. Investments must, therefore, support domestic capital structures so that private inflows are country-led and sustainable. Now, India's own example with the Skill Impact Bond illustrates how local systems can house catalytic capital. Obviously, with the kind of talks that we are hearing on the trade front, especially with the announcement last evening, as well as, apart from India, all other countries are also, I would say, are equally impacted. And with what we have seen with USAID and other agencies as well. So with declining official development assistance and the rising debt pressures and fragmentation, global investors must need to mitigate risk by embedding local currency, decentralization, and participatory risk sharing into the structures that they envision. So these are the 4 points in which I feel that the key implications for the impact investors in Global South as well as for India. I think that what we will do now is we will open the floor for questions and answers, and anyone having the questions can actually just type it on the chat box. Would that work, Varun?
Yeah.
That sounds great, Girish. Yeah, we have a couple of questions already.
Yeah,
Sure.
we have 3 very interesting questions. So maybe we can start with those. Thank you for your question, Ashish. I'll just read out the question for everyone. Are the PIMs, which are those investment models for blended finance, theoretical, or are there actually examples for them? And are there any sectoral preferences? So it's a good question. I think many of them are not theoretical because there have been a vast number of blended finance structures. But the key issue is that it hasn't been documented, right? Because there's so many different transactions that happen. So convergence, because they have all the data on the various transactions that have happened, they have created these archetypes. So most of these archetypes actually represent real deals behind it. And yes, case studies are available of them. The report on PIMS itself is in the public domain, and the link has been shared in the PPT, which will be shared with all the participants. But some of them are not. So, for example, the one about creating a public debt fund, that has not yet happened. So that was a proposal that was discussed at FFD. But this larger point relates to data and transparency. Let's just look at our own country's example, right? When we talk with regulators and officials, different people will have different perspectives on what even constitutes blended and outcome finance. I'll give you an example. In the last budget for affordable housing, there's a Swabhim scheme, which officially mentions blended finance. The Ministry of Skill Development and Entrepreneurship, one of their biggest flagship schemes is the ITI upgradation scheme, right? Which explicitly looks to bring in private capital. So that's definitely an example of blended finance. The government of Madhya Pradesh has announced a budget for doing outcome-based financing at the state level, right? Niti Aayog has done outcome-based funding pilots for education. But these conversations are all very disparate. Certain states, specifically Goa, Karnataka, West Bengal, are now looking at setting up climate finance facilities, building on their state climate action plans. But where is the information and the documentation on this, right? It's kind of hidden in different corners with advisors and consultants and UN agencies and so forth. So all of this needs to be brought into the public domain, and that is the role that all of us have to play, and to bring these case studies out more and more and bring that data out. So the role for industry associations, we must give credit to IIC. They have something called the India Blended Finance Collaborative. You could just Google that and go to their website, and you'll see a lot of knowledge products around blended finance. But there's a need for more case studies and government approved case studies. So we're trying to initiate an effort in Niti Aayog and others to get some of these case studies out there specific to India. But a lot of global case studies are available. And to your question on sectoral biases and preferences, look, investors are there across all sectors, but broadly, I would say the biggest focus of large-scale blended finance has been on infrastructure and climate globally. But that's not to say that developmental topics of healthcare and education are less important. There's a lot of activity in that, particularly in the Indian context. And in fact, this is something I've argued, that when globally they say development and additionality is less, and they use that to criticize blended finance, in India, it's actually more, right? Because our efforts have been focused in India on education, on healthcare, on rural livelihoods, and the numbers, right? A $5 million bond in the US, an impact bond, will impact maybe, let's say, 1,000 people, which is still great. But in India, because the ticket sizes are so much smaller, like for Lakpati Didi, it's just 1 lakh rupees. So you could have almost 10,000 or even 50,000 beneficiaries. You saw for Skills Impact Bond, 50,000 beneficiaries. A Skills Impact Bond in New York would impact maybe 1,000 women. So you're impacting more people, and you're focusing on these developmental topics. And capital is available. It just needs to be structured, and the projects need to be scalable and viable. So hopefully that answers that first question. The second question, maybe Suresh, you would like to also give your view on this, which is when we're talking about outcomes finance, how do we think about verification, right? Verification needs to be independent, but it also should, and credible, but it also needs to be cost effective. And do we have issues of conflict of interest? But how do we handle the measurement? I mean, this is a big debate that happens in outcome-based financing.
Yeah, this is if you are getting the grant mode, general normally either CSR grant or philanthropic grant kind of thing, where the terms and conditions, what you agree with the guy, the agency which is providing the grant to you. Certification at the moment, it is at the national level, the NSDC certification. If they demand, if we need the certification of NSDC, then there is a cost involved in that. The agency which is providing the grant, which is open to that, the people can go to the NSD certification. If it is not okay, we have to train either they're skilled enough, either they get the job or not. That is the criteria for us, not certification kind of thing. That is the way, other way look at it. The recently, just I was visiting some of the ITIs in their Nasik and Navsari and Surat in Gujarat, where some of the ITIs training the people. They are getting certification, not only the local Gujarat certification, but also national level certification, the NCVT. So because of NCVT certification, they are going to the abroad, the Gulf countries and Middle East and kind of thing. So where that is valued. So depending upon the with whom we are working and what they demand, like outcome-based finance, if they're investing the money private capital, if they demand the provision for the budget for the certification, there is one thing is there. Second thing, the so people also look at the placement. Whether placement, if they got the offer to get the placement, that is where they can happy with that. No, the placement plus or the continuing the job, like 3 months, 4 months kind of verification kind of thing. This all depends upon the who are funding you. Actually, you are funding you and what they are expecting kind of thing. So certainly in outcome-based funding point of view, so there may be more stringent, more process oriented, and more qualitative. I don't know. That maybe that is expectations kind of thing. But currently, that is not that much of rigorous. I can say that.
Yeah. No, thank you for that. And the last question, the third question from Dr. Sanjeev Sarangi was on this issue of localization and specifically for a grassroots organization, right? So it's a very fair question, sir. But to be very frank, I think, look, a lot of this talk about private capital is by definition focusing on the private sector. So it looks at social enterprises or private enterprises because there needs to be a revenue model for blended finance to be applicable. Of course, for outcome-based financing, it's very different because there you do have not-for-profits who are recipients of outcome funding. But the not-for-profits need to have the previous point that was being discussed, a clearly measurable and priceable outcome. Or it can be a series of outputs, which eventually lead to an outcome. So I think this is the challenge with grassroots organizations. But the last point in that agenda that the finance minister laid out, and what many of us work on, is democratizing. And I see the question from Varun also on the democratizing. So I'll try to cover that as well. Is taking all this money from larger organizations and also supporting the SMEs, in different value chains. And as we know, MSMEs are themselves a very large bunch. For a medium enterprise, can be several, 100 crore, and a micro enterprise can be just like a couple of lakhs, or so. Those are the kind of enterprises I think Varun Kashyap and the great work that Let's Endorse is doing is also focusing on. So I think yes, there's a need to democratize, these instruments. It is happening. You're right that Varun, that the impact bonds and these kind of larger bespoke structures are not as scalable. But you'd be surprised at the large number of people now who are building different layers of solutions, different instruments. I mean, I'll name some of them, right? I mean, there's a company called the Blended Finance Company, right, which is trying to develop, let's say, income sharing agreements, which are pioneered in Africa. There's Light Rock, there's Impact Lens, who are working on different blended finance transactions with leading social service providers, companies like Haktar Shak and others. At a global level, you've got something called Roots of Impact. Check them out. They have created a suite of instruments to cater to different segments. I think Vibha is on this call. Look at the great work of Vilgro Innovations Foundation, right? They're doing unbelievable work. They're supporting hundreds and hundreds of social enterprises and with incubation, and now with blended finance products, pioneering the regulatory side of it, as well as the capital raising side of it. So I think you're right that there's been a lot of talk on this subject. And that's precisely the point of that presentation also, right? That the transition from Addis Ababa to Seville acknowledged that for all of this talk, there isn't that much blended finance and outcome finance at a global level. Things are not fair. Things are not correct at every level, from how the World Bank is doing it, to how large institutional investors are doing it, to how capital providers in India are doing it. So that frustration is felt by all of us. The question is, how do we address that? And and the simple answer is there's a regulatory component to it. There are regulatory challenges of blending capital and little regulatory niggles here and there. We do have new innovations like the social stock exchange, right, which Suresh spoke about, and I see Jyotsna ma'am is also in our meeting. Yes, Suresh, please come in.
No, regarding the private capital, especially in the space of education and health, the huge private capital is flowing to India, and let's see a lot of social business like setting up the chain of schools, chain of hospitals, and happening. These for the for-profit in nature or social business we can call it as. But whereas for not for profit, where the issue, where the private capital is not flowing there. So both the levels. One is that capital availability is limited. At the same time, the not for profits capability to able to uh, able to receive it by way of approaching the right institutes and kind of thing, and pitch for that, selling their idea and thought and kind of thing. The both the levels, it is there's some limitations are there. That a long way to go.
Correct. So with that, I think we're just on almost at the 6 p.m. mark, and I realize we missed out on a few minutes because of the technical difficulties in my end. But before I give it to Mala for the closing, I did want to request, we have the gentleman who actually initiated the FfD process many, many years ago, Mr. Nitin Desai, with us. So would you like to share any remarks before we close?
Well, I just want to say that I'm very delighted at what I've heard. Learned a lot from what you have said and what you have discussed and the questions which have been raised. Let me just say a word on the original Finance for Development meeting. See, when we did that in 2002, the focus was not quite what you people are doing. At that time, the focus was on two things. One was that, there have been nearly 2 decades of arguments about the global finance system between the North and South countries. But the reason for having that Finance for Development meeting were two things. One, the political basis for overseas development assistance was becoming weak. The original political basis for this was a political rivalry between the East and the West, between the capitalist countries and the communist countries, if you like. That had disappeared with the collapse of communism in 1989 in Russia. The second thing, which was very important, was there's been a dramatic increase in the flow of global finance from the 80s onwards, which is much larger than what you saw in the years before that, because of the way in which the whole technique for finance transmission changed in that period. So the focus of the Monterey conference was very much on development assistance and on the, if you like, the how do you handle the coherence and consistency of international monetary and financial flows. Part of the reason for that was also to connect the fact that the United Nations had successfully run a large number of conferences on substantive development issues, whether it was environment, whether it was sustainable development, whether it was women's rights, whether it was social development, etc. And a remarkably large, complex set of agreed development goals had come out. And one of the things that we were trying to do in that conference was to connect the finance world with the world on development agreements, which had been there through a variety of summit conferences which were held in the 90s. So in many ways, what we saw in Monterey was still where you're talking almost separately about what is the concessional finance and the commercial finance. What I find very impressive is that when you speak of blended finance and impact finance, you're connecting these two. You're connecting the two areas. We had not done that 20 years ago. But this is getting a little more connection there. I think it needs a certain amount of exploration also as to how do you connect these. Let me give you a small example. For instance, when I'm trying to see how can I use public spending as something which should promote private, useful private investment. Take, for instance, what is being done on education. A lot of governments provide land reasonably freely to the people who are going to set up educational institutions. But those educational institutions are run on a near commercial basis. Many of them are still organized as charities, but in fact, they're really run almost on a commercial basis. You take the private sector industries universities that we have now, and you see how much they charge, etc. You can see that they are basically almost organized as something which will bring in the commercial dimension of getting enough returns from the money that is being sweat in setting up an organization. You should pay for it. But it also does depend to some extent on things like free land or very low cost land from the government. So I'm very impressed by the fact that you have brought in this dimension of connecting the concessional finance and commercial finance in a meaningful way. And this is what I look forward to. So let me just stop here. And I would say this is now going much beyond what we talked about when we had the Monterey conference 20 years ago, 3 years ago, to be precise. Thank you very much. I really enjoyed this meeting. But I leave it to Kartikeya Desai to do more work rather than me.
No, and all of us together. This has been great. Thank you so much, everyone. And thank you in particular to IIC. And over to you, Mala.
So much.
I just have one request. Sorry to interrupt you, Mala. Is there a way that we can write question to all of you separately? Because Nitinji spoke about something very crucial, but I know we're out of time. So can we directly write to him as well on global financing? Is there a way? If you can send that to us as well.
Yes, yes.
Don't
can
ask
write to
me.
IIC
I'm
and-
now a retired man. Ask Mr. Kartikeya Desai. Let him give
Sir,
him
I've
the
got a
answers.
different question for Karthik as well, so don't worry.
You can send your questions, Rohini, to IIC, and they'll
I'll
pass
do
them on
that.
to the rest of us. Thank you.
Super.
I must say I was very impressed by, I hadn't seen it, but I was very impressed by the amount of information that was conveyed in this meeting. And the detailed information which is now available on many of the things which are connected with blended and impact finance. But impact finance information is a little weak, but blended finance information is quite widespread. So good, thank you very much for this meeting.
Thank you very much, Mr. Desai. Thank you, Karthik, Suresh, and Dinesh for sharing your insights. And thank you all for joining us today. And the session will be uploaded on YouTube as well, so in case you guys want to catch up. And thank you all. Bye-bye.
Thank you.
Right.